24 hours with JB. Let's talk. So let's get into it, man. Flipping through the pages. Here we go. High yield bonds offer a unique advantage that other bonds don't. Again, anytime you hear the word or term high yield bonds, you're dealing with junk bonds. That's what they refer to them as, right? Because they're a lot more riskier as well as other reasons. But again, high yield bonds always equated with junk bonds. Let's go. Even though a high yield is a better thing, right? A good thing. But again, equate the two. No, it's a bit of an oxymoron, but let's keep it going. High yield bonds offer a unique advantage that other bonds don't. Their returns are not strongly affected by changes in interest rates. They are influenced less by interest rate moves than other types of bonds are, and more by the health of the overall economy and its movement through the phases of the business cycle from growth to recession and back. Yeah, some more food. What treasuries and investment grade bonds offer are their coupon yields, which are closely tied to interest rates. So treasuries, that's the money that you're giving to the treasury in return for a bond certificate, aka an IOU, right? Throughout the course of you lending the Fed money, they are willing to pay you, right? They pay you through coupon yields or coupon payments. So those yields as well as payments are closely tied to interest rates. So here's where you have to defer and break down and know the difference. High yield junk bonds, aka junk bonds, they're not closely tied to interest rates. Reason being, they're tied for the most part to the company. So thus, if the overall health of the economy is doing good, that company is doing good, and it's what making a dollar, doing what increasing its bottom line, aka its net income. You understand what I'm saying? So thus, if interest rates rise or fall, high yield bonds are not really taking a hit and or are not being affected by the rising or the fall of the interest rates. Conversely, treasuries, aka treasury bonds, are closely related to the interest rates as well as the benchmark rate, which the Fed determines several times throughout the year. It's levels, beloved, but walk with me and I got you. Spreads matter far more for high yield bonds, and they widen and narrow throughout the business cycle. Spreads. This is where it's levels. Spreads is where you break down the essentially return that the financial institution is getting when trading bonds, because they trade bonds as well. This is behind the scenes stuff. I'll do a whole video on spreads. And listen, know this, spreads differ from asset class to asset class, let's say. Because when you're dealing with options, there's a bid and an ask spread there. When you're dealing with even stocks, there's a bid and an ask spread there. When you're dealing with bonds, as we're currently speaking, there's a bid and an ask spread there. So anytime you hear spread, know that there's a bid and there's an ask price. And that difference is the spread. Write that down. The risk premiums on these bonds reflect the concern that these bond issuers are more likely to default than issuers of government, agency, or investment grade corporate bonds. That's what I forgot to say. Anytime you hear investment grade, you're usually dealing with corporate bonds, right? They're a lot more secure. They're a lot more sturdy. So thus, they're considered investment grade, right? But guess what? Since they are sturdy, since they are robust individuals, they're not giving you as much of a higher yield as the junk bonds would. You understand what I'm saying? Let's keep it going. High yield bonds tend to move in tandem with stocks than with investment grade bonds. Historically, that has meant that high yield has tended to underperform when the economy heads into recession and stocks fall. For that reason, most investors may also want to allocate a portion of their portfolio to investment grade bonds, which historically have outperformed stocks and high yield bonds during, this is the R word nobody likes to talk about, recessions. That's good to know. Okay, longer term bond yields have been ticked up since the decision, suggesting that traders also don't expect the economy to crater. This is just a little something I put in my back pocket. Okay, the Fed doesn't want to return to the era of too low inflation that prevailed between the 2008 and 2009 financial crisis and at the end of COVID-19 pandemic. If inflation is too low, it's gonna have, you can say, an adverse effect on the economy. So you don't want inflation too high, but you don't want it too low. You want it more so in between, moving modestly or more so moderately, so that the Fed is not making irrational decisions or illogical decisions based off of an abundance of data, right? Based off of volatility taking place throughout the economy. No, beloved. In the economy, you want economic cycles such as peaks and troughs, right? That's always going to be the case, and you adjust accordingly as time progresses. But what you don't want is things going too crazy and or spiraling out of control in one quarter, right? Especially pertaining to the GDP, because the GDP gets tracked on a basis throughout the year, right? And two negative GDP quarters, that could signal a recession, although not technically. And anyway, it's levels. At any rate, it's levels. I don't want to give y'all too much. Let me give y'all one more. Rate cuts are generally seen as a bullish signal because the combination of cheaper borrowing and lower returns on cash holdings tend to mean more capital ends up in asset classes like stocks and crypto. Lastly, the Fed funds rate influences the prime rate, which in turn helps banks determine what interest to offer their customers. That's all I got for now. Listen, man, stay tuned, stay focused, keep your head in the books. I just wanted to tap in with you all. Thanks for following the journey. We are going to continue to exemplify greatness. My head has been in the books, as you can see, striving to break down the economy so that I could simplify it even further to you all so that we could all thus thrive. Not necessarily on Wall Street, but perhaps on Main Street, right? But again, we need to know what's going on. We need to educate our minds. We need to strengthen everything that pertains to us so that we can be a part of the economy and not of the economy. We don't want to just be another statistic. And if we are another statistic, we want to be the good statistic and not the bad. Some people don't even get reported as a statistic, right? At any rate, I digress. Heavy on the investments. Stay tuned.